We're jumping straight into Taiwan Semiconductor Manufacturing Company today. Everyone is watching the price action, but the real story is the massive 2026 capital expenditure bet and the 30% growth guidance.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Yeah, and before we really get into the weeds of these massive numbers, and trust me, we're definitely getting into the weeds today, make sure you're subscribed and go ahead and hit that like button. We're here to simplify the complex machinery of the market for you, and you really don't want to miss what we have coming up.
So, let's just start with that top line number you threw out there in the lead. 12.71 billion US dollars.
Yeah.
In a single month.
Yeah.
Just January 2026.
Which is just well, it's a staggering figure, but context is everything here, right? Because usually January is a pretty sleepy month in the electronics world.
Right, yeah.
You've just finished the massive holiday rush, everyone already has the new gadgets, and the supply chain usually takes a bit of a nap to recover.
Precisely. That is the standard seasonal pattern. You expect a bit of a hangover.
Exactly.
But Taiwan Semiconductor's revenue wasn't just up year over year. I mean, it hit a 37% jump compared to January 2025.
Which is wild on its own.
It is, but it was also up almost 20% just from the previous month, from December 2025.
Wow.
That completely violates the normal laws of semiconductor seasonality.
So what is actually happening here? Is this just, a backlog clearing out, or are we looking at a completely new baseline?
It's an acceleration. And to understand why, we really have to look at the guidance management just put out. They are projecting full year 2026 sales growth of around 30% in US dollar terms.
Okay, I want to pause on that number for a second. Let's unpack that.
Sure.
Because 30% doesn't sound crazy if you're talking about like a small software startup.
Right. For a nimble startup in Silicon Valley, 30% growth is a Tuesday.
Exactly.
But we're talking about a mega cap industrial giant here. They have massive physical infrastructure. They pour concrete. They move heavy machinery.
Yeah, they build actual physical things.
Right. For a hardware manufacturer of this immense size to grow at 30% is incredibly rare. It's honestly like watching an elephant sprint like a cheetah.
That is a terrifying image, but I totally get the point. It just defies the physics of large numbers.
It does. And to really appreciate how impressive that is, we have to look at the rest of the neighborhood, the broader global foundry market.
Meaning all the other guys making chips.
Exactly. The Samsungs, the global foundries, the legacy players. That whole broader market is only forecasted to grow by about 14%.
So let me get this straight. The industry as a whole is growing at 14%, which is decent.
Yeah, 14% is a solid year.
But the market leader is growing at 30%.
Correct. It means Taiwan Semiconductor is eating everyone else's lunch. They're growing more than twice as fast as the industry they already dominate.
That's insane.
They aren't just riding the wave, they are the wave.
It feels like they have a cheat code. But, I mean, we know what the cheat code is, right? Just 2 letters, AI.
It is absolutely AI. The demand for artificial intelligence chips is just insatiable right now. Every major tech company is in a massive arms race, and the ammunition is silicon.
Yeah.
But I do think it's a mistake to say it's only AI.
Really? Because that seems to be literally the only thing on the news.
It dominates the headlines, sure. But we are seeing a recovery in non-AI sectors, too. The smartphone market is finally waking up after a long slumber. High-performance computing for standard servers is waking up.
Right.
But let's be honest, the main engine room, the thing that allows them to defy gravity and post that 30% growth, is the AI accelerator market.
And that leads us perfectly into the concept of the moat. We talk about economic moats a lot on the Easy Money Show. How hard is it to compete with a business?
Right.
In this case, the moat seems less like a ditch and more like an ocean filled with sharks.
It really is. Let's look at the market share data because the numbers just tell the story better than I can. Overall, the company holds about 71% of the total global foundry market.
That is a monopoly in all but name.
It basically is. But here is the insight that most people miss. That 71% includes everything. Washing machine chips, car chips, key fobs.
The basic stuff.
Right. If you strip away the older, simpler stuff and look specifically at what they call advanced nodes, the cutting-edge AI chips, that market share number jumps to over 90%.
Over 90%. That is wild.
Yeah.
That essentially means almost every major AI breakthrough, every chatbot you talk to, every predictive model running in a data center somewhere is running on silicon that came out of their fabs.
Correct. And this creates massive switching costs. Think about their biggest customers,
And
companies like Apple and Nvidia.
the titans.
Exactly. These are the titans of tech. They have basically infinite money. But they are essentially locked in. Nvidia can't just take their blueprints for the latest chip and walk down the street to a competitor.
Wait, why not? I mean, a factory is a factory, isn't it? If I have the blueprints, why can't I just give them to someone else to print?
You would think so, but no. It comes down to two main things: yield and packaging. Taiwan Semiconductor has a massive technological edge in the manufacturing process, specifically the 3-nanometer and 2-nanometer nodes.
Right.
The physics involved here is just mind-bending. They are printing features the size of a strand of DNA using light that doesn't even occur naturally on Earth.
It literally sounds like science fiction.
It basically is. But the real secret sauce lately is advanced packaging, specifically something called CoWS, chip on wafer on substrate.
Okay, hold on. CoWS. That sounds like a brand of breakfast cereal.
It does.
Break that down for us. Why does that specific packaging matter so much?
So, in the old days, you just made a chip and soldered it to a board.
Simple enough.
But today, advanced AI chips are actually multiple chips stacked together. Memory, logic, power, all stitched together into one massive superchip. It's like 3D chess, but with silicon. And this company has mastered the art of stitching these things together better than anyone up on the planet. If Nvidia goes to a competitor, they might get the individual chip made, but they can't get it packaged with the same speed, heat management, and reliability.
So they are happily stuck.
Exactly. Happily stuck.
It sounds like a very profitable marriage. And that stickiness really shows up in the margins. Let's talk about the money, because this is where the business model starts to look like a software company in disguise.
This is the part that usually makes value investors double-check their spreadsheets, because they just don't believe it at first glance.
In the fourth quarter of 2025, their gross margins hit 62.3%. And they aren't stopping there. They are guiding for 63 to 65% for the first quarter of 2026.
Let's unpack that for a second. Gross margin is essentially how much money you keep from a sale after you pay for the direct costs of making the product. The silicon wafers, the chemicals, the electricity, the labor. For a hardware company, keeping over 60 cents of profit on every single dollar of sales is almost unheard of. Usually, heavy manufacturing is a brutal grind. You fight tooth and nail for 30 or 40%.
Exactly. Usually you only see 65% margins in software, where the cost to sell one more copy of a program is literally zero. But Taiwan Semiconductor has to build billion-dollar factories to sell more product.
It just speaks to their incredible pricing power. Because they are the only game in town for the best chips, they can charge an absolute premium. Apple and Nvidia aren't negotiating price anymore. They're negotiating allocation.
They're just begging for capacity.
Exactly. They're begging to get in line. And because their factories are running at such high utilization rates, meaning the expensive machines are rarely sitting idle, their efficiency is just through the roof.
And despite this massive run-up in the stock price, I mean, we are looking at around $334 per share recently. The valuation metrics suggest it might not actually be expensive.
That's the surprising part. If you look at the PEG ratio, that's the price to earnings ratio divided by the growth rate, it is currently less than 1.0.
And for those listening who don't speak fluent finance nerd, explain why a PEG under 1.0 is the magic number.
Sure. A PEG of exactly 1.0 implies a stock is fairly valued relative to its growth.
Yeah.
Anything under 1.0 suggests that the market is actually underestimating the future growth.
Okay.
It signals that the stock is cheap relative to its potential. Effectively, the market hasn't fully priced in that 30% growth guidance we talked about earlier. You're essentially paying a Toyota price for a Ferrari engine.
That is exactly why you are seeing analyst consensus targets sitting around $470. That implies there is still about 40% upside potential from where we are sitting today.
Exactly. The math suggests there's plenty of room to run.
So let me just recap the bull case here for everyone. You have dominant market share, you have expanding margins that look like a software company, and a valuation that looks cheap compared to the massive growth. It sounds like the perfect stock.
It does sound perfect on paper.
But looking at the flip side, there is always a flip side. If it was this easy, everyone would just buy this one stock and retire on a yacht. We have to look at the risks.
We do. Because when a company looks this flawless, the only things that can derail it are usually massive external forces or a massive internal misstep. And right now, the company's flirting with both of those risks.
Let's start with the internal bet. We mentioned the capital expenditure earlier, the CapEx. They are spending an absolute fortune.
Fortune is an understatement. They are guiding for 52 to 56 billion US dollars in capital expenditure for 2026 alone.
$56 billion. To put that in perspective, that is higher than the GDP of many small countries.
Yeah.
It's more than Intel and Samsung used to spend combined not that long ago. And compared to 2025, that is a roughly 40% increase in spending year over year.
It's an incredibly aggressive bet. They're building massive new capacity, buying the most expensive machines in human history, and expanding their footprint. The risk here is simple. What if they are wrong?
What if the demand isn't there when the factories are finally finished?
Right. The field of dreams risk. If you build it, will they actually come?
Exactly. Right now, the AI megatrend looks completely unstoppable, but we have seen bubbles before.
Think about the fiber optic bubble in 2000. Companies spent billions laying cable that nobody used for a decade. If the AI revolution slows down, or if companies like Microsoft and Google decide they have bought enough chips for a while and just need to digest what they have.
Taiwan Semiconductor is going to be left with $50 billion worth of new capacity and nobody to buy it.
And that would be a disaster for those beautiful margins we just talked about.
It would be catastrophic. In manufacturing, high fixed costs are great when you're busy. That's operating leverage working for you. Every extra chip you sell is pure profit.
Right.
But it works in reverse, too. If those expensive factories sit idle, you still have to pay for the maintenance, the depreciation, the staff. That 65% gross margin would evaporate very quickly.
So that's the financial risk.
Yeah,
But we can't talk about this company without addressing the dragon in the room, geography.
the Taiwan discount.
Yes. The stock trades at a forward price-to-earnings ratio of around 23 times. Now, 23 times earnings is moderate. It's not cheap. But for a company growing this incredibly fast, it's actually quite low. If this company were based in Kansas or Switzerland, it would probably trade at 40 or 50 times earnings easily.
So the market is essentially applying a permanent discount because of the geopolitical tension?
Correct. The market absolutely hates uncertainty. And the location of their primary manufacturing base, 90% of their advanced capacity is still on the island of Taiwan, is a source of constant geopolitical friction.
Yeah.
You can't model a blockade in a spreadsheet. You can't predict it. So investors demand a higher return, which means a lower stock price to take on that risk.
And it's not just the politics, it's the physical reality of the island itself, right? We've seen major issues with power and water supply.
That is a critical operational vulnerability that really doesn't get enough headlines. Semiconductor manufacturing is incredibly thirsty and incredibly power hungry.
Right, those machines run hot.
These advanced machines consume the power of a small city. And the factories require millions of gallons of ultra-pure water just to clean the silicon wafers.
And Taiwan is prone to severe droughts.
They are. If there is a severe drought or a power grid failure or an earthquake, which happens frequently in that region, the fabs stop. And if the fabs stop, the revenue stops instantly. It is a very tangible physical risk.
So while the company is perfect on paper, the external world, both the politics and the infrastructure, provides significant friction.
Exactly.
So we have the bull case, unstoppable growth, monopoly status, and great value. And we have the bear case, massive spending risks, and very real geopolitical danger. For the listener holding this stock or looking at it right now, what should they be watching in the next few months? What are the key signposts?
We have a few key catalysts on the horizon. The first one is coming up relatively soon, the first quarter 2026 earnings.
That is expected in late April 2026.
Right. When that report drops, you want to ignore all the media noise and look at one specific number, revenue. Management has guided for a midpoint of roughly $35.2 billion.
So if they hit that $35.2 billion, the story is perfectly on track.
Yes. But if they miss that number, or more importantly, if they guide lower for the following quarter, it could be an early sign that the AI demand is finally softening.
And given that they are spending $50 billion based on the assumption of high demand, any crack in that revenue story is a massive red flag.
Exactly.
And I'm guessing we need to watch those margins, too.
Absolutely. They promise 63 to 65% gross margins. You need to check if they actually sustain that. If margins slip, say, down to 61% or 60%, it tells you something is fundamentally wrong.
Like what?
Well, it could mean their costs are rising faster than they can raise prices. Or it could mean they're having trouble filling all that new capacity.
That would signal that the moat might be leaking a little bit.
Precisely. And the third major thing to watch is the CapEx execution. They have a $50+ billion budget. How are they actually deploying it? Are they successfully expanding overseas?
Right. Are those new factories in Arizona, Japan, and Germany coming online on time and on budget?
Because if they could diversify their manufacturing footprint, that Taiwan discount might actually start to shrink.
That is the long-term play. If they can prove they can build high-quality ships outside of their home base, which has honestly been a struggle for them historically, the geopolitical risk premium goes down and the stock price likely goes up.
They need to show they aren't just a Taiwanese company, but a truly global one.
And broadly speaking, we just need to keep an eye on the macro picture for AI.
It's the tide that lifts this entire boat. As long as the sector rotation into semiconductors continues, and as long as companies are racing to build bigger and smarter AI models, this company benefits disproportionately.
Because of that 90% AI market share.
Exactly. They are the toll booth. If you want to drive on the AI highway, you have to pay the toll.
I love that analogy. They are the toll booth for the AI revolution. It really doesn't matter which car wins the race. Tesla, Google, OpenAI, they all have to pass through the toll booth.
It really is the best way to think about it. They don't have to pick which AI software company wins. They don't care if a startup fails or a tech giant succeeds. As long as someone is building AI, they get paid. They are literally selling the pickaxes during the gold rush.
So let's bring this all home. What is the lowdown?
The lowdown is that this is a company firing on all cylinders. The fundamentals are arguably a 9 out of 10. They have the growth, they have the insane margins, and they have the dominant market position.
But they are making a massive bet. $50 billion big.
They're betting the future of the company, that AI is not a fad. They're betting that this demand is real and sustainable for years to come.
And as an investor, if you buy the stock, you are essentially making that exact same bet right alongside them.
You are. And you are accepting the geopolitical risk as the price of admission. You are betting that the world needs these chips so badly that politics won't get in the way.
It's a high-stakes game, but so far they're playing it better than anyone else on the planet. I do want to leave you with one final thought to mull over, though. We talked about tech giants needing these chips, but what happens when sovereign nations decide they need their own AI infrastructure? If governments start demanding domestic chip production for national security, how does a centralized toll booth adapt to a world that suddenly wants a dozen different highways?
That is a fascinating question and definitely something that could reshape the next decade of this industry.
Something to keep in mind as this story develops. All right, that is a wrap on Taiwan Semiconductor. We hope this cleared up the noise around those massive January numbers and gave you a peek under the hood of arguably the most important company in the world right now.
It's a fascinating story of technology, money, and power.
It always is with this market. If you got value out of this breakdown, do us a favor, hit that like button, subscribe to the Easy Money Show, and share this with a friend who needs to understand what is actually happening in the chip market. We'll be back with another analysis soon. Until then, keep your eyes on the data.
Stay curious.
See you next time.